While you watch this video, tens of billions of dollars will change hands in a market almost nobody outside a bank has ever actually seen work. It's called the foreign exchange market, Forex, and according to the Bank for International Settlements, it now moves more than $9.5 trillion every single day, and it's growing fast, up 28% from $7.5 trillion a day, just 3 years earlier. So what actually is this market? And why does it move more money in one day than most countries produce in an entire year? Forex is simply the market where one country's currency gets traded for another's. No single building, no opening bell, no central exchange anywhere on Earth. It's a network of banks, governments, funds, and brokers trading directly with each other, 24 hours a day, 5 days a week. It opens in Sydney, hands off to Tokyo, then London, then New York, and by the time New York closes, Sydney is already opening again. Here's why this market exists. Say a US company wants to buy machine parts from a supplier in Japan. That supplier doesn't want dollars. They want yen because that's what pays their workers and their bills. Somewhere in that transaction, dollars get converted into yen. That conversion is the Forex market. It happens at an airport currency counter, when a company pays an overseas supplier, or when an investor buys a foreign bond. Because you're always trading one currency for another, Forex prices always come as a pair. The world's most heavily traded pair is the euro against the US dollar, written EUR/USD. The first currency is the base. The second is the quote. The price tells you how many dollars it takes to buy 1 euro. So if EUR/USD is quoted at, say, 110, that means 1 euro costs you $1.10. Here's something most beginners never get explained. Every Forex quote is actually two prices, not one. The bid is what a broker pays you. The ask is what they charge you, and it's always a little higher. That gap is called the spread, and it's how most brokers make money, whether you win or lose your trade. So why does the price of a currency change at all? Simple version: supply and demand. More demand pushes the price up, less demand pushes it down. What drives that demand is interest rates, inflation, trade flows, politics, and market sentiment. What central banks do with interest rates. When the Fed raises interest rates, global investors want to hold dollars more, because their money earns more just sitting in them. That pulls in foreign capital chasing the better return, pushing the currency's value up. So when the Fed and the European Central Bank move rates in different directions, EUR/USD tends to move too. Inflation numbers and GDP growth, not because the number matters alone, but because it changes what people expect the central bank to do next. Markets don't just react to the news. They react to the news being different from what everyone already expected. That's why good news can send a currency down, if traders expected something even better. Now here's the part that draws in a lot of beginners, and hurts a lot of them too: leverage. Leverage lets you control a large position with a small amount of your own money. U.S. regulators cap retail Forex leverage at 50-to-1 on major pairs. That means with $2,000 of your own money, you could control $100,000 in currency. Leverage multiplies your gains, but it multiplies your losses exactly the same way. A move that would barely register without leverage can wipe out your account with it. That's just the math, which raises something most retail traders don't realize. This market wasn't really built for them. More than $4 trillion a day moves through FX swaps alone, used almost entirely by banks and institutions moving real money. Individual retail traders make up a small slice of that $9.6 trillion total. Institutions get tighter spreads, faster execution, and far more information. Retail gets access, not the same playing field. That gap is exactly what a lot of get-rich trading Forex content online quietly leaves out. Forex isn't a shortcut. It's one of the most competitive markets on Earth, and you're trading against professionals who do this all day. Most beginners don't fail because Forex is rigged. They oversize trades, ignore the spread, and treat leverage like free money instead of borrowed risk. So Forex isn't secretive, and it isn't rigged. It's just enormous, fast, and mostly invisible. $9.6 trillion a day, moving between banks, corporations, and traders. Every hour the sun is up somewhere on Earth. It's a market, not a machine that prints money. Understanding how it actually works is the difference between using it and being used by it. If you want to actually understand how markets work, instead of guessing at them, that's exactly what this channel is for.